Good morning. It's Jeffrey Christian of CPM Group. It's not quite 10 o'clock on Friday, the 15th of July here in New York. Hot and steamy day and a hot and steamy week in the markets. We have a lot to cover on. I'm going to try to go very quickly, but there are a variety of topics I want to talk about. Obviously, inflation. And inflation factors into interest rates and the gold and silver markets. I want to talk about agricultural commodities very briefly because people asked about that. Platinum group metals, people have been asking about that. I want to talk about the Silver Symposium, which CPM Group is going to participate in, and some pretty interesting things that we'll be doing there. And related to that is silver conspiracies and silver conspiracy theories. I'm going to be giving a presentation there. I'll talk about it at the end. And then I want to talk about the unparalleled concentration of short positions on the COMEX silver contracts by the largest banks that trade silver. And you can see here, got part one and then part two at the end. So you got to stick around for the full bit. But let's talk about this. Everybody has heard about the unparalleled concentration of short positions in the silver market. And you know, the silver conspiracy promoters have talked about, you don't see this in any other market. Well, here's the data from 2005 to the present for the percentage of the short positions, commercial short positions, held by the four largest banks that trade silver. And you might not be able to see it. You know, we've done this data for decades. And we updated it recently, simply because people are talking about it. You might not be able to see it on here, but you can see the bold red line is silver. This is the percentage of the short position held by four largest commercial entities, financial institutions, banks, trading companies, whatever you want to call them, on the silver COMEX contract. And the red line shows you the concentration, and you can see, well, maybe you can't see, but it's basically 20 to 30% for most of the time from 2005 till the present. Right. The other lines, which I put less prominently so you can see them, but they don't crowd the silver one, include the same data for copper, gold, platinum, and palladium. And you can see here that the concentration in the silver market basically is below that for copper, below that for gold, and about the same for platinum and palladium. Now I'm going to show you more data at the end, so you got to stick around. And I will also explain why this is so. It shouldn't be a surprise that this is the case. The data has always been there, and both on an empirical, statistically driven basis and on a theoretical basis, if you know how commodities trade, this should not have been a surprise to anybody. We've talked about it repeatedly. The CFTC has talked about it repeatedly. Other informed sources have spoken about it repeatedly for decades. And yet you hear about it ad nauseum by the silver conspiracy promoters and by people who believe it. Right? So I'll get back to this at the end. People ask me about commodity prices. And I've showed you this chart earlier in the year, a couple months ago. We've updated it through June. The blue line is the food cost index in the consumer price index. And the orange line is the GSCI agricultural index. This is wholesale prices. Actually, these are commodity prices, agricultural commodity prices. And we go back to 2000, and you can see a steady increase in consumer prices with a sharp increase starting in the second quarter of last year. And you can see a steady decrease in the wholesale prices of food over the same period of time, starting to rise actually in the middle part of 2020 during the lockdown and the problems with supply deliveries. But you can also see that at 0.6, wholesale prices are 40% off. from where they were at the beginning of this period and where they were in 2008. We have some real problems with agriculture. And what's happened here and what you're seeing here is that you have across the agricultural sector an increased concentration of processing and distribution of foodstuffs. It's true in meats, it's true in vegetables, it's true in grains. And those concentrated, economists might say it's an oligarchic control. Several companies, four or five meat packers these days, down from dozens of them, a couple dozen 20 years ago. The same is true with grains and with vegetables. This oligarchic control in the processing and distribution of agriculturals have allowed those companies that process and ship this stuff to squeeze the producers, the farmers and the ranchers, and say, I'm just not buying your cattle. I'm just not buying your lamb. And to also increase the price to the wholesalers and retailers that they supply, and thus to the consumers. So what we really have here is a concentration of processing and distribution, which has allowed certain companies to become extremely profitable and has squeezed farmers, squeezed ranchers, and squeezed consumers. There are benefits to large scale farming. You know, we have tremendous amounts of food, and those people who said we can never feed the world have been repeatedly proven wrong. But there are obvious negative consequences. And as we go forward in time, those negative consequences become more. Now, I could go on and on and on about agricultural commodity markets. We've done a lot of work forever, since the 70s in that. So yes, we do agricultural commodities. Most people know us as precious metals commodities because that's A, one of our big areas of expertise, and B, it's what people want to talk about. Most people don't want to talk about oats and corn and soybeans and issues related to agricultural production and consumption. They want to talk about gold and silver and how those banks in New York are conspiring to do stuff that they don't actually do. So that's agricultural commodities. Again, a lot of territory to travel, and I'd really like to limit this thing. Inflation, CPI came out this week. It surprised a lot of people. It surprised CPM Group. We thought it would be over 8.4%. It was 9.1% on a headline basis. You can see here, this is the CPI through June, year over year. The headline continued to rise. The core inflation, which excludes food and energy, which tend to be more volatile, actually declined for the third consecutive month. So that's telling us that, yes, the upward pressure on consumer prices is in fact peaking, but there are still problems. The really scary and bad part about it was that the increases were across the board. And if you get the BLS study, you can see just about every sector of the economy saw higher prices. Now, if you go back to the second quarter of last year, that's when prices started to rise. This goes to June 21. And you can see inflation was running about 4% from June into August, year over year basis. What we were looking at for much of last year were energy prices, food prices, and used cars and trucks prices rising. And other sectors of the economy were not showing that kind of inflation. As the energy prices and food prices increase, that increases the costs for people involved in every sector of the economy. And what we've seen over the last 4 or 5 months is the rest of the economy playing catch up. So you're seeing a very broad-based increase in prices as the inflation that was focused on energy, food, and used vehicles a year ago is now being reflected in other parts of the economy increasing prices. It's still likely to be peaking over the next 6 months or so. It's still a problem, but it's not hyperinflation. We're not actually talking about 17% inflation the way some conspiracy theorists would have you have it. And if you look at it, again, here on a month-to-month basis, last year was devastating, and it was across the board. If you look at it on that's the data, you probably can't see it, maybe you can blow it up, I don't know. You can get it at bls.gov. You can get the report, it's about 37 pages long. It has all kinds of information that would blow the minds of most people who pontificate on the YouTube about how high inflation is. Because most of them have never actually read a monthly CPI report. If you look at the personal consumption expenditures, which is important because this is what the Fed watches. The Fed feels this is a better measure of consumer prices than the consumer price index. And the Fed has dozens, if not hundreds, of economists who study the BLS's inflation data, not only the CPI but the PPI. And the BLS has hundreds of economists and thousands of field workers collecting the data. But the PCE is important because this is what the Fed watches. And you'll see that it's lower than the CPI. It's about 6.5%, I guess, on a headline basis. And if you look at it ex food and energy, it's about 5%. And we saw a little bit of a spike down. We also saw PPI come out, the producer price index yesterday, and it actually was showing some declining increases except in energy. And very important, the cost of transportation for wholesalers, for companies on the producer level, the transportation costs were down. And that has been a major factor of fueling inflation over the last 15 months. Markets. We have seen gold and silver prices fall very sharply. We talked about this in the Tuesday video. We put discussions into various reports that we've put out for clients, the gold trade recommendations, the silver trade recommendations. You know, gold and silver haven't fallen in a vacuum. We've seen a massive decline in stock market, in corporate bond prices, in other commodities, and in currencies other than the US dollar. We're having this shift in investor attitudes and financial market attitudes. You know, the first half of this year we're focused on higher inflation. That's bad for the economy. It's good for gold and silver. Oh wait, higher inflation means higher interest rates. That's bad for the economy, and it's bad for precious metals. And we're going into a recession. And now I think the financial consensus is, okay, inflation may be peaking. Interest rates may not be rising as high and as fast as people thought, although this week's CPI and PPI may change that. But I'll get back to that in a second. And we're probably going to avoid a recession. If you look at the interest rate expectations, the CME has a contract where they sort of gauge the financial markets inflation interest rate expectations, and they're baking in the market, not the Fed. The Fed's mentioned the possibility of a 1% increase. The Canadians have increased their interest rates 1% this week. The market is baking in a 1% increase at the end of this month. They're baking in, I think, a 75 basis point increase in the next Fed meeting, and then maybe 25 bips, and then maybe nothing. So the market assumes that interest rates will rise, but probably rise more sooner than had been expected 6 months ago, 3 months ago, 2 months ago. But they probably will rise more slowly beyond the next few months. And that has been reflected in disinvestment in gold and silver, along with just about every other asset. Now, are we moving into a recession? Today, the Fed came out with its industrial production figures, and for the second quarter, it was averaged about 0.3. That's really low. in the first quarter, where we saw GDP basically negative, we had industrial production up about 0.6. So industrial production in the second quarter has been about half as strong as it was in the first quarter, and we saw a negative GDP in the first quarter. That is evidence that we may well see a negative GDP figure for the second quarter. The first flash estimate of second quarter GDP will come out at the end of July, and then there'll be 2 subsequent revisions. But in this kind of environment, and with the seasonal weakness that you often see in gold and silver, it's not surprising that markets have come off. They've come off as we had expected. We've been saying that we thought the gold price could go down to 1680, maybe even 1650 during the summertime. It got down to 1695 a couple times this week. Silver has been weaker than we had expected. We thought that it probably would hold above $18, and it didn't. It is above $18 now. It's also showing some greater strength than gold because there's more investors coming in and out of the futures market. So that's the markets. Our expectation is that the prices stay weak for the next month or so, and then they could possibly rise. And I will point out that last year, we had the gold price drop to like 1680 or so twice. And within a couple months of each decline to 1680, gold got back up to 1900 or higher. So you're looking at volatile markets. Expect that volatility to continue as the financial markets wrestle with where are we in the world economically and financially, and what's going to happen politically in the United States, in Europe, the Russian war in Ukraine, Chinese issues, both domestic and foreign. A lot going on that will keep the markets unsettled. I want to talk about platinum group metals. We will be releasing our platinum group metals yearbook on July 26th. You can register for the online webinar seminar that we will have on that day, talking about what we're seeing with platinum, palladium, and rhodium. Prices have been very weak, along with everything else. No surprise. Auto demand is the biggest use of platinum, palladium, and rhodium, and the auto industry has not been able to really increase production the way they would have liked. There's a great deal of uncertainty in the markets about supply and demand trends. There are all kinds of numbers that are like, you just look at them and you say, wow, how could we possibly have this big of swings in the supply and demand and the market surpluses? So there's a great deal of uncertainty about what supply and demand is really doing. We will address those issues in detail on the 26th of July. I won't bore you with them now. You can pre-order the report at our website, and you can register for the webinar more at that place. The Silver Symposium. We're encouraging everyone to come to Spokane at the end of August and participate in the Silver Symposium. We want this to be the best. We want this to be the go-to silver event globally. And I'll be honest, it already is. Last year was the first year. This is the second year. You look at the group of speakers that they have some really good speakers, and they have some very interesting companies. There are 3 producers that will be there. There are several exploration companies, and we're working hard to encourage other producers to come and to be there. So you can sign up at Eventbrite. There is, I think, some sort of discount for CPM group, people who register via CPM group. We'd appreciate it if you did that. You can also go to the silversymposium.com and register there. And I think there's a place where you can say, yeah, CPM group sent me. We'd appreciate that, just so they know where you're coming from. At the Silver Symposium, we'll give a speech on the real silver market, what's really going on in supply and demand. We will, again, as we did last year, host a lunchtime open forum question and answer period where people can ask respectfully questions. If they're disrespectful or they're hot dogging or hoo-haing or whatever you want to call it, we'll call them what they are. But if you want to come in and have an open discussion in a respectful, intelligent, informed fashion, ask us any questions. We have no presentation for that. And then on Tuesday evening, we're going to have a presentation and discussion. And it starts around 7 o'clock. And we're doing it in the evening, so it's open-ended. We've done this in the past at various events, and sometimes the hotels have come to us and said, hey, you have to close this up. It's midnight. You've been talking for 4 hours, and our staff has to go home. And public transportation is not very good in Spokane, so it's not like they can get on a bus after midnight. That presentation is going to be the evidence for and against silver conspiracy theories. The presentation we've made for decades. It gets more and more elaborate as more and more passes and evidence mounts. If we can, we're looking for a sponsor. We want to bring the retired head of market surveillance from the CFTC, one of the brightest people I've known in the metals business. I met him in the late 1970s, and he has done a remarkable job in every position that I've seen him in. And I'm looking for a sponsor to bring him to Coeur d'Alene, possibly to give a presentation during the speech, but also to be there for this evening event. It could be really, really interesting. And that leads me to the next thing, the percentage of short positions in silver compared to other things. I had shown you at the beginning, silver compared to gold, silver, gold, platinum, palladium, and copper. And you could see that silver did not have unparalleled short positions. In fact, it had positions that were less concentrated than gold and copper. Okay. Here, we're comparing silver to oats, soybean meal, and natural gas. And again, you can see it's right in the flock. It's not as big as natural gas, but it's not as small as oats. Now, I said at the beginning, I'll explain this. Silver market's enormous. There are a lot of investors involved. There are a lot of producers involved, consumers. And the financial institutions that service that see that and say, hey, we can provide services to people who are trading gold, silver, silver. So you have more financial institutions providing hedging and counterparty services in the silver market than you do in smaller markets where you have less activity. So a smaller market will often find that you have fewer financial intermediaries providing the offsets. You know, for every investor that goes long a commodity, there's got to be a financial institution that's willing to take the short side of that trade in the futures market. Right. So if you have a commodity like oats, not to just say anything bad about the oat market, I love oats. You have fewer participants, and those participants who are providing financial support services have a larger percentage of the short position. In silver, you have more people. Natural gas, you have more people. So how? It's lower. Surprise? Empirically, it makes sense. Theoretically, it makes sense. The data supports it. And yet there are folks out there who will tell you that you have never seen such a high concentration of short positions among the top 4 banks trading them. You can believe what you want if it helps you to sleep. Come to our website, cpmgroup.com. You can get free reads. I will be showing those 2 charts in greater detail, hopefully in bolder type, at the Silver Symposium. They're part of that presentation on the evidence for and against silver conspiracy theories. There's no evidence. Tip you off. You can find all kinds of things on our website. You can sign up to plug into the PGM yearbook briefing. You can actually buy the PGM yearbook for $160. You can also buy the gold yearbook and silver yearbooks, which came out earlier in the first half of this year. And you can read all kinds of things about the markets. Until next week, take care of yourselves, take care of everybody else. Thank you.